Good day, ladies and gentlemen. Welcome to Value Partners Market Outlook 2023. My name is Ricky. I'm the co-head of Client Portfolio Management for Value Partners, and I'm happy to be here as the moderator of today's event. Today, we're honored to have our co-chairman and co-CIO, Dr. cheahchenghye, as well as Value Partners investment experts across different asset classes to share with us their views and investment strategies for 2023. We'll start with Mr. Che, who will share with us the survival strategies in the current stormy markets. Then Ms. Kelly Cheung, our head of multi-asset, will discuss our asset allocation views in this new market regime. Senior Fund Manager and A-shares expert, Mr. Luo Jing, will then provide us with some suggestions on how to navigate the recovery in Chinese equities, while Mr. Gordon Ip, our fixed income CIO, will look at some bright spots in the Asian credit market. Last but not least, Mr. Frank Trey, head of ESG investments, will share some insights on where we see ESG opportunities in Asia. We've also spared some time to answer your questions at the end of the session. Please use the Q&A function to send in your questions. Now we have just 1 hour and a lot to cover. And so without further ado, let's start with our first session, in which Mr. Che will share with us his insights on how investors could do to survive in this stormy world. Mr. Che, please.
Thank you for joining. In recent weeks, we have seen one positive surprise after another from Beijing. There have been a faster than expected easing of COVID restrictions, for example, and even a rescue package for the property market, and a positive move in the right direction in terms of relationship between China and the United States. In fact, I believe China has started a new cycle of growth and recovery. At the Party Congress last month, it was confirmed again that economic growth is now China's #1 priority. In fact, it is very logical. You can see that economic growth is the main solution for many of the challenges faced by China. We saw panic buying from late October. Many Chinese stocks went up by 20% or more in just the last few weeks. My analysis is that there is now a potential for the Chinese stock market to increase by another 20 to 40% in this new cycle. But having said that, of course, I must caution that market behavior is such that it almost never goes up or down in a straight line. So there may still be some turbulence ahead, but in general, that direction is very positive indeed. Let's review the key factors according to the textbook, why markets go up and down, and add in a new factor as well. The key factors to determine market direction traditionally has been the direction of the economy, meaning whether corporate earnings and dividends go up or down, direction of interest rates, which determine the price of money, and the direction, very importantly, of investment sentiment. A new factor, of course, will be geopolitics, which in the past wasn't such a big thing, but now can have a direct and immediate impact on market direction. For China, all the above factors have been moving in the right direction at last. In fact, from March of 2020 and 2021, all those factors were moving in a negative direction for China. We are now seeing a turnaround. This is really major. Look at this slide, for example. You will see that for the coming year, China is the one economy showing solid growth. Most forecasters for China's growth in 2023, including that from IMF, is for growth of 4.5% to 5.1%. This particular forecast is extracted from a new Goldman Sachs report. You can see that much of the developed world has entered a slowdown, or even potentially there could be a risk of recession. But China is coming into a new cycle. China is able to turn around, partly because inflationary pressures are low in China. So there's room for stimulus, even some room perhaps for moderate easing of interest rates. And the new property rescue package announced by the Chinese government assures a soft landing for the troubled property sector. geopolitical tensions have been reduced by the recent meeting between President Biden and President Xi in Bali. The United States has said to the media is not seeking a confrontation with China. And despite all that, Chinese stocks, despite the recent rally, remain at rock bottom valuations. Valuations that we last saw during the global financial crisis of 2008. So you can see why people such as myself, who've been following China since the 1980s, are pretty optimistic. Although I would say we also know that market behavior can be at times unpredictable, but the general direction looks pretty good right now. Now, I think it's also important to put China in the global context, how it looks for a global investor. The world that my generation of investors know has changed a lot because we're used to a world where the US dominated, provided an umbrella, a sense of security and safety. We investors only needed to focus on investing, on business, on commerce. And we can let political leaders and military generals take care of the geopolitics, but that's not true anymore. Global order, as you know, has broken down. We have been swept by social unrest, financialization, inflation, war, etc., even climate change. We are seeing weaponization of trade, money, food supplies, even human talent. So I think the prevailing investment approach of the last maybe 25 years, known in the media as FOMO, F-O-M-O, fear of missing out, doesn't really work anymore. The FOMO approach almost guarantees investors that they'll be whipsawed, meaning they end up buying high and selling low because markets have become so volatile, so unpredictable. And the central bank put, meaning expecting the central bank to come to the rescue of markets at each and every crisis. Frankly, central banks have run out of room to do that kind of rescue packages, except in a few countries like China. Yeah. So I would show you on this slide that we have enjoyed too long a period of easy money, almost like free money, negative interest rates. The amount of money printed since the 1996, according to this slide, have increased several times the size of the real economy. There's very little room left, and it has become a very fragile situation of over financialization and rising inflation. How do you survive in this challenging environment for a global investor? I would argue that you survive by identifying long-term, durable themes for investing. Themes that allow you to ride out the roller coaster swings of the market, where almost every prediction can be proven right or wrong. But what you want is a solid, durable investment theme that allows you to hold on with conviction and eventually allows you to preserve your wealth and pass it from one generation to another. I will identify, it's up to each investor to figure out what his preferred long-term theme is, but the key is that you must have a situation where you can avoid the risk of buying high and selling low, i.e. getting whipsawed. For me, examples of long-term themes will include energy assets, food assets, key commodities, including copper and lithium, defense stocks, because the world is getting increasingly uncertain. And one of my favorite themes is Chinese stocks and bonds. China simply has become too big to ignore. And the key to sustainable investing, in my view, is to find a sustainable society that can withstand this era of huge social and global and monetary and financial disorder throughout our planet. Now, from this slide, you can see that there is a foundation for China that, to my mind, is the foundation of sustainability, a large and growing middle class. China's middle class today, 400 million people, is larger than the entire population of the US and is growing very fast. Chinese middle class people are likely to number something like 800 or a million or so by the end of the decade. This is a very solid foundation of an inclusive society that people buy in, and that allows the country to provide its own huge domestic market for innovation, manufacturing, and distribution. It's a self-contained continental economy that I think provides a high chance of sustainability, which in my view is key to wealth preservation. There are very significant changes going on in China in terms of how people save and invest their savings, their money. And this is really the world's largest pool of savings. Notice from this slide that the 25-year addiction of the Chinese public to buying property is beginning to fade away. This is something that's happened only since the COVID started. So many people don't realize this, but Chinese household wealth used to be more than 50% represented by just one asset class, real estate. Today, it's more like 37%. Meantime, the percentage of household assets allocated to capital market products, to professionally managed funds, has risen, see the pink line, to 13% from just above zero a generation ago. Chinese people are discovering the value of investing in the capital market, and this is something the Chinese government is nurturing. They want it to happen, this reallocation of savings and wealth, because property is over-invested. It was actually a bubble, and it was not very productive anymore. 80% of Chinese households in the cities already own one or more properties. So China wants to redirect savings to productive investments, especially innovation, green energy, manufacturing. And it is happening. Why we are excited, of course, is that it means there is a lot of new money waiting to enter the stock market and support share prices and valuations, all from the Chinese mainland. You will see from here there's also at the same time, in terms of supply of new ideas, new initiatives, a lot of Chinese companies are choosing to IPO in Shanghai, Shenzhen, and Beijing, the mainland domestic markets. This assures a lot of new opportunities for the public to enjoy, to invest their savings. Again, moving away from the property market. So overall, we are quite confident to say that a new cycle has started in terms of whether you talk about the economic cycle, you talk about structural changes, you talk about valuations, you talk about sentiment and the overall global economy. I think China is entering a new era. It's the turn of Chinese stocks to shine. Thank you very much.
Thank you, Mr. Che, for the insightful sharing. Those strategies are definitely going to be very useful for investors, not just for 2023, but also over the medium term, given the change of regime in the investment world. Speaking of regime change, it is a good segue into the second session, in which Ms. Kelly Chung, our head of multi-asset, will share with us how we could enhance our asset allocation strategies in the new market regime. Kelly, over to you.
Thank you, Ricky. Hello, everyone. 2022 was a very volatile year. Besides geopolitical events, inflation and rate hike were in focus in developed markets. All asset classes except the US dollar and selected commodity prices have been hit hard in 2022. The positive correlation among asset classes has been one of the highest in history. Investor positioning has become very extreme. The volatility in currency added to the difficult investment environment. 2023 will continue to be another volatile year. The US and Europe will be facing higher recession risks. Inflation will remain high and central banks need to continue to tighten. The governments in the US and Europe will be more difficult to use fiscal policies to support the economies when their monetary policies are still on a tightening mode. Therefore, US and Europe are likely heading into recession. Especially Europe may have a high chance going even into stagflation. On the other hand, China faces a different economic cycle. After facing some very hard time due to the property sector slump, COVID lockdown, and fading export growth, China is now about to turn around. With the direction towards gradual reopening and growth development, there will be more supportive policies helping the economy heading into a recovery. Liquidity is ample in China after significant increase in credit supply this year. When confidence stabilizes, we believe consumption growth could lift the economic recovery. Other emerging markets and South Asia are still in an expansionary stage, although the pace of growth will be slowing. They will continue to benefit from the full reopening, although the effect will be fading into 2023. Most Southeast Asia countries are having a healthy current account surplus. The economies will be supported even the US is still under a rate hike cycle. In the US, inflation has peaked, and with the higher base going forward, inflation will continue to slow down. However, service inflation such as rent and wages are sticky and more difficult to come down significantly, although they are trending down. Therefore, we believe inflation will remain higher than the Fed's 2% target in 2023. As you can see in the chart, real interest rates in the US remains firmly negative. History told us that in order to slow demand and lower the pressure of service inflation, a positive 1 to 2% real interest rate is needed. Therefore, we believe the Fed will continue to hike rate at a slower pace but for longer. With the accumulating effect of rate hike, the US economy is difficult to avoid a recession. It is also indicated by the inverted yield curve. As you can see in the chart, historically, every time when the yield curve was inverted, the US economy was followed by a recession. So we think this time will be no different. On the other hand, as I mentioned before, Asia, particularly China, will fare better under this difficult global environment as the countries have more tools to support the economies. Regarding valuations, valuation in Asia, particularly China, is more attractive. In the US, current consensus on earnings growth for next year is still positive 5%. With the current expectation, S&P 500 is still trading at 17 times. Some sectors, such as technology and consumption, have already lowered their earnings guidance and performed cost-cutting aggressively as demand slows. Therefore, we believe that under a deteriorating economic environment with tighter liquidity, negative earnings growth is possible for next year. As such, both earnings expectation and valuation multiples have to come down. Therefore, there will be more downside in US equities. On the other hand, as you can see, valuation and earnings growth are more reasonable in Asia. Valuation in China is at historical low range. Company earnings have already bottomed, and we still see upside to the current earnings expectation. With the gradual fine-tuning on the COVID policy towards reopening, Chinese equities will be gradually recovering from the bottom, and re-rating should be warranted when sentiment improves. In conclusion, 2023 will continue to be a volatile year. We prefer equities over fixed income overall. Fixed income will perform better than this year as a large part of the rate hike expectation has been priced in. However, upside is also limited. The inverted yield curve makes the term structure unattractive. Credit spreads in both investment grade and high yield bonds in developed markets have not widened much this year, and the risk of further widening remains as more earnings downgrade will be coming and with the potential of economic deterioration and earnings recession. On the other hand, after a distressed year in Asian credits, with fears spreading from the Chinese property sector to the whole asset class in 2022, there is good investment opportunity in the healthy companies with strong balance sheet. Credit spreads have started to stabilize, and valuation is now attractive. However, focusing on the higher quality spectrum and credit selection remain crucial while maintaining a lower duration stance. On the equity side, we prefer Asia, particularly North Asia, as China will lead the recovery and re-rating of the stocks. On the alternative side, we believe energy will remain supported, while gold is a good hedge against any escalation on geopolitical risks. Overall, an active allocation is needed to manage risk carefully under such a difficult market environment.
Thank you, Kelly. It looks like North Asia is going to be one of the very few bright spots for 2023. With that, how exactly can investors tap into the market recovery story for China? Which are the reopening beneficiaries? And following the 20th Party Congress in October, have there been any changes to the structural growth areas in China? Our senior fund manager and Asia specialist, Mr. Luo Jing, is going to share how investors should navigate the recovery in Chinese equities. Luo Jing, the stage is yours.
Good day, everyone. It's not an easy year for the equity market in 2022, but we expect to see a recovery in Chinese equity market next year. China's economy is relied more on the top-down process. The 20th Party Congress should be the most important meeting in the next 5 years, which set the overall target and direction for the whole country. What we read from the 20th Party Congress report is the paradigm shift from a core and sole focus on development to a set of more balanced and comprehensive targets, namely development, quality, and security. However, this paradigm shift hit investors' confidence in China as the market gauged that the top policymakers would put the security before development and also put the Fed before efficiency. But we believe the market has overreacted to these changes. Firstly, it remains unchanged that the development is still the first priority. The difference is that the latest report gives higher weight on the quality. The latter means the development safely and fairly, which refer to the objectives of security and common prosperity, respectively. Alongside escalating geopolitical tensions and wealth inequality, these objectives could tackle these issues and thus help to deliver a more stable development, making China a more sustainable society in our view. Secondly, some unchanged policy tones can support a relatively rapid GDP growth. For example, we saw the top policymakers re-emphasize the key roles of the market, tech innovation, rising middle classes, market-based reform, and further open up. Thirdly, the 20th Party Congress reiterated the target, raising the per capita GDP to the level of middle developed country by 2035, implying a target annual GDP growth of around 4% in the next 13 years. In this case, China will still be one of the fastest growing major economies. Overall, the policymakers have laid out a more balanced set of targets on development, security, and quality. But there is no doubt that economic growth is still the first priority. Let us move on to the next part for what we are bullish on. High-end manufacturing industry will be a key growth driver for China, given its irreplaceable position in the world and strong competitive advantages. Why it is irreplaceable? China's industrial capacity ranked number 1 in 40% of the industrial goods categories in the world. 30% of global manufacturing value added came from China in 2020. That is, without China's contribution, the world would give up over 30% supply of industrial goods and result in dislocated supply chains and unacceptable inflation. We also believe that China will keep its leading position in manufacturing and continue to move up the value chain. First of all, China's industrial system has covered all the main categories of manufacturing. This could form industrial clusters and generate positive synergies, such as lower inventory cost, more flexible production, and so on. Secondly, it is supported by a high-quality education and growing R&D capability. There are over 4 million STEM graduates per year in China. Additionally, China has ranked number 1 in terms of the international patent application numbers, and over 20% of the global R&D came from China now. The engineered dividend and the rising R&D investment will support the country's industrial upgrading. Thirdly, the second infrastructure and measured energy cost also helped. Over the past decade, China has invested a total of $30.8 trillion in improving its infrastructure, which equals around 15% of its GDP. This compares with less than 5% of GDP invested in infrastructure in the rest of the world during the same period. Infrastructure is a key part of productive fixed asset and will help China improve its productivity and to be cost competitive in the coming decade. Moreover, comparing with the surging energy cost in EU this year, China has maintained a relatively stable and reasonable energy cost in the past, which is also a key factor to encourage manufacturing investment. Overall, we expect companies who are well positioned to China's manufacturing upgrading could generate positive alpha and offer solid investment opportunities. Next, the consumption story is not over. We expect the sustainable economic growth and the emphasis of common prosperity should help to reinforce the elimination of extreme poverty and raise the percentage share of middle-income class, which would further scale up the consumer market. According to HSBC's estimate, China's middle classes were more than 600 million in 2021 and will grow to around 800 million in 2030, especially for the upper middle class, who could earn around $20,000 per year, will double from nearly 200 million in 2021 to 400 million in 2030. Meanwhile, we expect further urbanization and the broader coverage of public services should drive people to save less and spend more in the longer term. According to the 20th Party Congress report, the civilization of rural population will be key driver of urbanization. The report stresses to further deepen rural land system reform and give farmers full property rights and interest. As a result, we expect urbanization ratio to further rise from the current 60% level. Furthermore, better offering on public services may also help. For example, the hospital bed per 1,000 people was up from 4.2 in 2012 to 6.7 in 2021. Finally, some pro-consumption policies are likely to be rolled out, given China's internal circulation strategy. Therefore, the consumer sector will sustain solid growth ahead, and high-quality consumer names should enjoy the trend. Wealth management is another area full of opportunities. Despite the near-term macro headwinds due to the COVID policy and the property downturn, we expect China to return to more sustainable growth in the longer term. Disposable income uptrend will pile up household fortune, which should drive the expansion of the investable asset from $21 trillion in 2020 to $50 trillion in 2025. Meanwhile, the weighting of financial assets will rise at the expense of declining share of real estate amid policy of housing for living, not for speculation. We expect the share of financial product to grow from 13% in 2021 to 21% in 2030. Lastly, this year's China equity was like a roller coaster, and it's not the fun kind. Given the extremely pessimistic market expectations and the high possibility of the normalization of China's macro and policies, we believe the risk-reward is at the sweet spot for long-term investors now. We prefer use equity risk premium as a good measure of market risk return profiles. ERP are high in both onshore and offshore China market now. Particularly, the rocketed ERP in offshore market reflect the most extreme pessimism of stock investors in 2 decades. The best time to invest China is now. Thanks all. I will stop here and now pass to the next speaker.
Thank you, Lo Jing, for sharing. Chinese equities definitely are offering a lot of interesting value opportunities for investors. But apart from equities, we have also seen values returning to fixed income markets, given the rise in yields and widening spreads, especially for Asia. Let's ask our expert, Mr. Gordon Ip, our fixed income CIO, on where in Asian credit space we could find these opportunities. Gordon, please.
Hi, I'm Gordon Ip, Chief Investment Officer of Fixed Income at Value Partners. 2022 has been a very difficult year for Asian credits. Not only the Asian credit market has suffered from multiple macro headwinds, from COVID, rising inflation and global interest rates, to the war in Ukraine and other geopolitical conflicts. Our market has also been under intense pressure due to various policy headwinds in China. Looking ahead in 2023, although we can't really say all of the above will disappear, we think there are signs that will make us feel more constructive in Asian credits, especially Chinese credits. First of all, valuation. Asian credits are extremely cheap right now. In particular, the high yield market is extremely cheap, both in terms of absolute yields and credit spreads. For example, both Asian and Chinese high yield credits are currently yielding well over 20%. And in terms of credit spreads, well over 1,000 basis points and more. On the other hand, we are of the view that Asian and Chinese investment grade credits will remain supported in 2023. Therefore, we believe that after the disappointing performance in the last 24 months, Asian and Chinese high-yield credits could be an interesting risk-reward proposition for investors to consider in 2023. To further demonstrate the cheapness of our market, let's look at how our markets compare to itself historically. Currently, the spread of Asian IG credits is trading at 2 standard deviations on the cheap side for the past decade or so. And the yield of Asian high-yield credits is hovering around 3 standard deviations cheap. Now, for those who are familiar with statistics, this means there is only 2.5% of the time in the past decade that Asian IG will be cheaper than the current valuation. And for high yield, a staggering 0.15% for the past 10 years. These are shocking numbers, but also reasonable and understandable, as what the market has experienced in the past 24 months was indeed unprecedented in the history of our market. Now, specifically for China property. China property credits staged a strong rebound after the central government's 16 measures to support the property markets and 20 measures to optimize the country's COVID response. Although we don't expect to see an immediate improvement in contract sales, we believe the new measures provide a favorable condition for the market to recover from the bottom. In fact, there have been more loosening measures being rolled out since the second quarter of this year, and we believe this trend will continue. Other than China property, another interesting opportunity in Greater China credits is Macau gaming. As a tourist destination and a regional gaming hub, Macau gaming has also suffered from China's COVID policy, which have limited travel. There is also the uncertainty of gaming license renewal, which in our view should be cleared out very soon. As we believe China will further reopen and relax traveling, we think Macau gaming is a very interesting space to look at in 2023. What's more, how about clean energy, specifically the Indian renewable energy space? Supported by the government and the global trend of using green energy, the Indian renewable sector has seen consistent growth over the years, and renewable energy is projected to account for a higher proportion in India's future energy mix. Also, if investors are keen on ESG investing, this is a sector you may consider next year. So finally, to conclude, 2023 could be a year of opportunities, although some of the macro headwinds may still be around and sporadic volatility are to be expected. However, as our title said, when there is a will, there is a way. If investors are interested in capturing the extreme cheapness and great relative values of Asian credits, there are ways to achieve that goal in 2023. Thank you.
Thank you, Gordon. It sounds like the opportunities in Asian credit space are quite diversified and interesting. One area that Gordon mentioned is renewable energy, which is related to ESG investing. In fact, ESG-related investments is definitely one of the fastest growing areas in recent years. According to Bloomberg, there will be roughly $9 trillion of assets going into ESG strategies in the next 3 years. For Asia, where are the ESG opportunities? Our head of ESG investment, Mr. Frank Choi, will now share with us where those opportunities are. Over to you, Frank.
Thank you, Ricky, and it's nice to meet everyone here. In my today's sections, I'll be going through some of our observations with regards to the ESG investment here in Asia, and also about where we see the opportunities here in Asia. I think when we're just looking at the overall ESG investing universe here in Asia, it's a bit disappointing to see the drop in AUM in 2022 from nearly about $90 billion AUM to about $70 billion AUM. But the positive side of it is the drop in AUM is basically driven by the negative market impact. And in fact, there has been a continuous net inflow into ESG funds and respective investment here in Asia. We see that trend will continue to gather pace, especially going into 2023, basically contributed by two supporting factors. First is the improving disclosure and also about the data quality. There has been a lot of developments here in Asia about adopting international standards. The recent FMCC promoted by Hong Kong SFC that requires local asset managers to disclose the climate-related policy in the investment process, as well as the RTS Level 2 requirement that will be effective in January next year. And also we have been seeing and contributing some of our views to the associations and the ESG working group in the industry peer about the adoption of ISSB. All this will contribute to the improving quality and also disclosure here in Asia, making the data efficiency more attractive for a lot of investors. And based on our experience, the last 2 years' time, we have been seeing tremendous pickup in terms of the depth that asset owner and our investors are asking on ESG disclosures. So we believe this practice will continue to drive the demand. And also the second part is the ongoing support from the ESG-related investments supported by the governments and regulators. There has been tremendous picked up, especially here in Hong Kong, with regards to green financing projects, and making a lot of the green projects seeing tremendous growth in the upcoming years. But where are the opportunities lying on here in Asia? I would consider there will be two attractive and hot topics here in Asia. First, I think climate remains as a hot topic, especially for China, given its significance in various aspects. If you look at the charts on the top, right-hand side and the left-hand side, China is actually the largest carbon emitters in the world. And here in Asia, China contributes over half of the carbon emissions. The commitment in achieving the carbon neutrality by 2060, it's very, very determined. And I think what we're seeing in the local market right now is there has been continuous ramp up in capacity expansion, and also about corporate practice on how to decarbonize the existing business practices. But the opportunity doesn't really lie only on domestic market. If we look at the opportunities on the bottom of this table here, the left-hand side, we see solar panel, all the renewable energy, smart grid, all these would attribute to the carbon neutrality, not only in China, but all over the world. They're taking up a huge and significant market shares around the globe. In solar panel, just take it for reference, it takes up over half of the global market shares. And the EV, electric vehicle battery supply chain, the battery actually takes up almost about half of the global market shares. But what we are seeing is not only about climate, because it's actually more focused in China, but if we take a step back and look at how Asia is looking into ESG investment opportunities, we think the food value chain is looking very promising, as well as very robust in terms of the growth. I think this is driven by a couple of factors. The table that I've listed here is the food value chain, going from agri-tech, food processing, packaging, to delivery, and to consumer apps and services. All these have been increasingly contributing to various SDGs goals, such as zero hunger, clean water, life below water. There are actually a couple of reasons to support this thesis. First, in Asia, there will be 2/3 of the population of middle class residing here in Asia by 2030. And these group of people will be driving the needs for food security, food nutrition, or what we call the premiumization of food essentials. On the right-hand side of this chart, you will be actually looking at about 7% annualized growth, supported by both domestic consumer preference and behavior, and also the macroeconomic factors such as demographic change. So there's a huge need for premiumizations of the whole food value chain. And to support these needs and demand, there will be enormous amount of CapEx deployment in technology investing. Actually, when we're looking at the overall landscape here in Asia, we're actually looking at a very promising double-digit growth, such as on vertical farming, alternative meats, manufacturing business here in Asia, and that will be contributing by about $1 trillion investment or CapEx deployment by 2030 to make it happen. Agri-tech is actually one of the areas that we're seeing decent ESG opportunities here in Asia. The other key factor is actually the online food penetrations. I think in this part, the ESG contributions will be coming from the accessibility of foods, as a lot of the online retailers or food delivery, they are actually improving the accessibility of foods, and also about cutting the waste, and also about energy consumption by centralizing the food distributions. That actually has been seeing enormous and sustainable growth within key top 10 players here in Asia, which average about 20% annualized growth rate from now to about 2023. Last but not least is the inflation hedge that we're seeing the overall food and nutrition or security space will be benefiting investors from the increasing food prices around the globe. There are actually two key factors driving this investment thesis. First is the long-term factors that we're seeing extreme climate change that actually has been damaging or affecting the harvest of various agricultural products, and also about the strong demand for quality food. As we mentioned, there will be a huge demand on driving premiumizations of the food value chain. The macro factor actually is a little bit more human-driven, is the geopolitical tensions. Earlier, we are actually seeing the Russia-Ukraine situations is driving a lot of picked up in energy prices, and that will also be contributing to various commodities, including foods. And in the near term, we still think the pandemic impacts is still driving a bit of supply shortage in some areas, particularly in China. So we think all this combined together, we're actually seeing improving investment opportunities for the food value chain. The universe consists of about 600 names here in Asia. We're talking about 1.5 trillion market cap. The team is actually looking into respective opportunities within the food value chains. And we hopefully will bring in more interesting ideas and positioning within our portfolios heading into 2023. This is the end of my sections. I really appreciate your time. And I'm happy to take any questions that you may have. Really appreciate that. Thank you.
Thank you, Frank, for the sharing. Now, let's move to our Q&A session. I've already seen quite a lot of questions coming in through the chat function. So let's perhaps start with a question which we've been asked very much recently. I think all of our audience would like to hear from Mr. Che on your views. So, Mr. Che, there's been a lot of debate recently on whether China is still investable. What's your view? Is China still investable?
Yeah. Thanks for the question. The word investable, or rather in this case, uninvestable, typically appears at the bottom of a market. In the case of China, calling China uninvestable by some investors is understandable because there have been a major decline, in some cases 50% or more, in the price of large sectors of the Chinese stock market. But in fact, I think the fact that such words appear signify a major market bottom. We should just look at the facts. In fact, China today is the most active stock market in the world. For every buyer, there is a seller. For every seller, there's a buyer. Lots of people are buying Chinese stocks, and lots of people are also selling Chinese stocks. This slide shows you that of the world's 6 largest stock markets in terms of trading activity, 3 are Chinese: Shanghai, Shenzhen, and Hong Kong. So that's far from being an uninvestable market. There are lots of people very happy to be trading this market. Now, secondly, you may have seen that since late October, there has in fact been very major turnaround in investment sentiment about China. For example, here is a headline just came out from Bloomberg saying that Wall Street's major brokerage houses, investment banks, are now saying one should be buying China. It's a major turnaround from a couple of months ago when most of them were quite bearish on China. One last slide to show you is that I think, in fact, sentiment against China is partly the result of the differences between the Chinese and Western systems. The Chinese emphasize long-term solutions, even though that may create short-term pain. The Western system, because of the electoral cycle, 4 to 5 years there's a new election, emphasizes a quick fix, short-term gain, long-term pain. Some people may prefer the Western system because you have immediate gratification, whereas the Chinese emphasize delayed gratification. But investors should be looking for sustainable long-term solutions to how to preserve their wealth and manage their savings. So I would say that over the long term, the Chinese system is actually more logical for an investor. Thank you.
Thank you, Mr. Che, for the sharing. Now, let's move on to the second question, and this question is for Kelly. Kelly, you have discussed your views on equities, fixed income, and alternatives, but you haven't shared your view on currencies. And this question is about the US dollar. What is your view on the US dollar? And will it further strengthen in 2023?
Sure. We believe the US dollar has already peaked because the fastest pace of rate hike has already begun, and the Fed is now going into the next stage of rate hike, which is at a slower pace but for longer. Therefore, we believe that the US dollar will be around at this level towards the year end, and the other currency will be kind of also range bound towards the year end. However, for next year, we believe the US dollar will start to slightly depreciate. It is because the accumulation effect of rate hike will definitely deteriorate the economic growth. So we believe the US for next year will start to heading into economic slowdown or even recession. On the other hand, for the other currency, which has been hit hard this year, such as the renminbi, we believe that next year it will start to slightly appreciate. So overall, for the other currencies, we believe the upside will be higher than downside for next year going forward.
Thank you, Kelly. And I see that there's a question on equities, and that's for lodging. In your session, you discussed the opportunities of high-end manufacturing.
Yes.
In addition to high-end manufacturing, are there any other technology-related sectors that we should pay attention to?
Sure. Thanks for the question. Yeah, besides the high-end manufacturing, we think that technology will be another space full of opportunities. And as the 20th Party Congress report emphasized a lot on tech innovation, self-sufficiency, and we think that there will be more accommodative policies in this area, and there will be more investment and more demand in this area. So that will create a lot of opportunities for companies specializing in these areas. So for us, we really like those areas, including semiconductors, 5G related areas, and also new materials. However, that all these hot areas, they are all have really high valuations. So for us, as the typical value investors, we should always balance the long-term growth potentials, the sustainable free cash flow creating capabilities, and the valuations. We need to balance all these factors and be really selective in these areas. And on the other hand, we also like those traditional consumer electronic OEM players. We all know that they have very strong capability in all those low-cost, high-quality manufacturings. And currently, we also notice that even though the consumer electronical has really sluggish demand in the world, but those players are trying to penetrate into other areas that may also utilize their capabilities to develop this kind of high-end manufacturing capabilities. That includes the automobile OEM business. And also, all those players currently has really low valuations. That actually bodes well for their future stock price performance. Yeah.
Thank you, Loi Jing. Looks like there are actually a lot of opportunities in Chinese equities outside of high-end manufacturing. Now, there's a question on ESG, so it must be for Frank. What is Value Partners doing differently in ESG assessment? And what do you think is crucial based on your ESG research experience?
Well, thank you, Ricky. I think this is a very good question. And this is exactly the question that we asked ourselves when we formalized our responsible investing policy back in 2019. I think it's not more about how we do it differently, but it's more about how we think it's a sensible approach, it's relevant, and it works here in Asia. I think ESG in Asia, it's a bit different in a sense that it's an emerging market. So the ESG development is still at the same stage that it's emerging. So when we adopt the global standards here in Asia, I think what we had concluded is there are two essential pillars that we need to embed in our approach. First is we engineer our own proprietary assessment framework. And second is the active engagement. For the first, proprietary assessment framework, I think it's extremely crucial because here in Asia, because of data inefficiency, because of low data coverage, and also about the compatibility of the data, it's essential that we build our own models and structure. So this is first thing. Second thing is the engagement. Engagement here in Asia, you will uncover a lot of interesting facts about companies' efforts because they're transitioning from not ESG aware to ESG aware and become ESG as an ESG improver. Often, based on my experience, is that after the engagement, we often have to revise our ESG rating because either the public information overstate or understate some of the company's efforts. I think this is also the strength that we could rely on Value Partners, that we have over 50 people, investment professionals, to conduct due diligence meeting. So we conduct 6,500 meetings a year. That is the exact strength that we have for Value Partners.
Thank you, Frank. So I think we now have time for one last question, and let's take a question on fixed income. So it's for Gordon, who is online with us today. Gordon, while we have seen more supportive policies for Chinese properties recently, have we finally seen the bottom yet? Is it time to buy into Chinese high-yield bonds again now? What's your view on that, Gordon?
Thank you, Vicky. I think this is a question that most investors have also in mind. So as China continues to reopen, and as you said, more evidence of supportive measure by the government, we have reasons to believe that our market has likely bottomed. However, as we expect global macro could still be challenging, and there could be occasional volatility as well, we think investors should choose a well-diversified portfolio and pay attention to issue selections, as we believe picking names and picking securities could be a very important factor in the current environment.
Thank you, Gordon. So it looks like finally the tide has turned for China high yield, so investors get into the asset class again. Well, I see that there are still a lot of questions in the chat function. Unfortunately, we may not have time to answer all of them today. But please rest assured, our business team will get back to you on your questions. Thank you very much for joining Value Partners Market Outlook 2023. We hope you enjoyed the session, and we look forward to seeing you again next year. Have a great rest of the day.